monetary policy. But before we go into the finer details of monetary policy, let us understand what is monetary policy, what are its objectives, and how are they met. If you thought that the main job of central banks is to work their printing presses and dish out new banknotes, well, that's not the case. The central bank in any country manages interest rates and money supply through various monetary policy tools, which we will dwell upon in detail in the ensuing sessions. A monetary policy is part of the general economic policy of a country, and hence it seeks to attain certain objectives of the economic policy, like promoting growth, controlling inflation, and managing a stable exchange rate. Let us look at each of these goals in isolation. Periods of economic slowdown, like the one we are seeing right now, is characterized by a reduction in investment and economic activity, which hampers growth. So there is a need to stimulate demand by inducing spending. But how do you do that? This can be done by increasing the supply of money. By increasing the liquidity and hence the availability of credit in the economy, the RBI can stimulate the demand. Say, for example, a person takes a home loan for buying a house, or takes a loan to buy a car, or increase the capacity in his factory. All result in increase in expenditure. The RBI can directly impact the money supply in the economy or indirectly by tweaking the interest rates. Earlier, the monetary policy used direct instruments like prescribing deposit and lending rates and credit controls. But now, since the reforms in the early 1990s, the RBI has taken a more flexible approach and hence it primarily tweaks interest rates to stimulate borrowings and thus investment. The second most important objective of the monetary policy is to control inflation. The problem with inflation is that it impacts the standard of living of people, hampers saving, and productive investments. There is now a convergence of views in both developing and developed economies that price stability has to be the main objective of monetary policy, and hence the RBI has recently adopted a monetary policy framework that targets to bring inflation down to set target levels. For instance, 6% by January 2016 and 4% thereafter. Controlling inflation sadly requires just the opposite solution to reviving growth: reduce money supply and increase interest rates. This triggered a spate of debate between the government, the central bank, and the industry about a year back when the RBI chose to increase interest rates to rein in inflation despite calls for lowering interest rates to revive the ailing economy. The third most important objective of the monetary policy is to stabilize the exchange rate. The value of a currency, just like the price of any good or service, depends on the demand and supply. Say, for instance, the demand of the rupee decreases vis-a-vis the US dollar, the value of the rupee depreciates, and vice versa. So, what does the RBI do under such circumstances? The RBI maintains a stable exchange rate by buying and selling foreign currencies in the market. For instance, if the rupee depreciates, then the RBI pumps dollar into the market. On the other hand, if the rupee appreciates, the RBI goes into the market and buys dollars. Thus, the RBI can supply and draw from its foreign exchange reserves. But India's forex reserves cannot always come to defend the falling rupee at all times. Take, for instance, when the rupee had a free fall to almost 68 against the dollar, the forex reserves had slumped to almost $275 billion. The RBI had to step in, increase interest rates, and curb liquidity. When we increase interest rates, the rupee also tends to appreciate because there is an inflow of foreign capital into the country because foreign investors, find it more attractive to invest in India. While each of these goals in isolation can be achieved by a monetary policy tool, in reality it is a little bit more complicated. With a fixed exchange rate and free capital flow, it is impossible to have an independent monetary policy. Let us understand this by an example. If the central bank chooses to increase rates to curb inflation, this attracts foreign capital into the country. The rupee appreciates and the RBI has to intervene to buy dollars from the market. This means that there is an increase in the domestic currency in the market. And with the supply of money going up, the interest rates tend to fall down. This is contrary to what the RBI wanted to achieve in the first place. increase interest rates to curb inflation. Now, with the broad understanding of the monetary policy, we will look at the key monetary policy tools in the ensuing